Hello, class. You're welcome to another class on corporate reporting. Remember that last week we started looking at share-based payments. So today we will round up with that. And for share-based payments, the key thing for IFRS 2 on share-based payments was that when an entity receives goods or services, they now pay for those goods or services with their equity instruments. You know, the conventional way with which transactions are consummated is that you receive goods, then you pay with money, or you might promise to pay later if you don't want to pay outrightly. But in recent history, entities are trying to manage their cash flows, and now they are paying for goods or services with their equity instrument. And that is what IFRS 2 wants to teach us how to treat. And this paying with equity instruments, there are three types of it. There are three types. Is either you have equity settled share-based payments, or you have cash settled share-based payments, or you have equity or cash settled. That of equity settled cash share-based payment, equity settled, we told you that this one is the one in which an entity receives goods or services and they use their equity instrument as consideration. And this, their equity instrument they are using to pay for those goods or services is either they are giving their shares or they are giving their share options. Either of the two. But we have seen that when an entity gives their shares, automatically the counterparty or the supplier automatically becomes a shareholder. So giving shares for the receipt of goods or services is common with suppliers or consultants because those ones would have actually delivered the goods or services. It's common with those ones. However, there is also share option. This share option is also part of equity instrument. Entity can give share option. And what share option is saying is that, yes, we are giving you a promise to become our shareholder in the future. You are not going to become our shareholder now, but you can become our shareholder in the future if you work hard. That's share option. If you work hard. So for you to become a shareholder, when an entity gives you a share option, you need to work for it, meaning that they will attach some conditions to it. So that is why share option is defined as a right given to a counterparty to receive the shares of an entity at a specified time at a specified price. So it's a right and a counterparty have to receive shares at a specified time at a specified price. So share option usually comes with conditions that the counterparty must work for. And it's common that they give these share options to employees, right? So it's usually when the transaction is with employees, that is when you will hear share options. Share options. And that's the one you even find in your exam, mostly for the most part of it. You see, for, for a shareholder or for an employee to become a shareholder with share options, that employee needs to work hard. And those conditions, that working hard, those conditions that the employee needs to meet, IFRS 2 calls it vesting conditions. And these vesting conditions is either they tell you that before you can become our shareholder, you need to have worked with us for 5 years, or for 4 years, or for 2 years. Service condition, you must have worked with us for a long period of time. They will attach that to it. Or they say that before you can become our shareholder, you must meet some sales targets or some profit targets that they call performance condition. So share options comes with condition. And for the most part of what we learned last week, we really focused more on share options. Because the challenge with share option is that because it always comes with conditions. It comes with conditions. So at what point are you then going to recognize it in your books? Is it when it is granted to the employee or when the employee has met the condition? We said that you should start recognition from when the employee starts working for the company. And that is in compliance with accrual basis of accounting. Because under accrual basis of accounting, we recognize transactions in the books of accounts when those transactions occur, when they happen. So as soon as an employee starts working for the organization, immediately we need to recognize those transactions, not when those share options vest, not when they vest. So for the most part of what we learned last week, we then try to understand that, okay, how much are we going to be recognizing every year? Every year, how much are we going to be recognizing? So I gave you several scenarios, which a lot of you participated in. So I don't know whether there's anybody here that was not in class last week. This is still under equity settled. So I gave you a scenario like, let me just put it here back. I gave you a scenario like if an entity gives 1,000 options to each of its 20 employees, and they give us the fair value of that option, because share options are usually measured at the fair value of that option at the grant date. I didn't tell you that if the transaction was with was with a supplier, they will have measured it at the fair value of the goods or services received. That's how they will value that transaction. But if it is with an employee, it's valued at the fair value of the option. So let's say the fair value of the option is, let's say, 4 naira. Okay. And they say that the service condition is that the employee must work for 3 years. Right? So how do we then recognize this in each year? Every year, how do we recognize how much are we going to be recognizing every year? I told you last week that IFRS 2 said that the amount we recognize every year should be an estimate of the number of employees that will vest. It should be based on the best estimate on the number of employees that will vest. And we took our time to really sort that out and ensure that you understood it before. And in fact, that was where we ended the class last week. So let me quickly review it again before we start solving questions. So I told you that If they told us that in year one, that 3 employees left the entity, they leave the company, and the entity estimates that 7 employees will leave over the 3 years. 7 employees will leave over the 3 years. So how do we deal with this? You said in year one, what that means is that we are giving 1,000 employees. So in year one, we need to determine the estimate of the number of employees that will vest. So in this case now, when they told us that 3 employees left, and the entity estimates that 7 employees will leave over the 3 years. So how many employees will vest based on year one estimate? So we are back to where you're supposed to participate, just to be sure that you remember what I taught you last week. So how many employees will vest based on year one estimate? Husseini, I can remember you very well. You were in class last week. I don't know about the others.
Yes, I was in the class.
Yes. So how many employees will vest based
That's
on year?
based on this assessment that you say 20 employee on this example.
Yes.
So if 3 will left, that 17 will vest.
Okay. That's your answer. Any other trial? Is there any of you that is in class, that was in class last week, that can remember what we did? So based on year one estimate, how many will vest? And when I say how many will vest, what I mean, what the standard means is that how many will vest at the vesting date? Because nobody is vesting in year one. But accrual basis requires that we need to recognize this transaction every year. We need to, because the employee has started working, so we need to book it. So, and the amount we recognize is each year will be based on the estimates of the number of employees that will vest. When we say that we vest, people are only going to vest after 3 years, meaning at the end of the third year. So when they told us that, okay, in year one, 3 employees left, so we're now estimating that 7 employees will leave over the 3 years. So I'm now asking you, based on year one estimate, how many employees will vest? So you said 17. That is wrong.
13.
Yes, thank you very much. That's 13. That's 13. Okay, so the question is clear that yes, 3 employees left in year one, but the entity is estimating that 7 employees will leave over the 3 years. So this is the estimate of total departure. 7 will leave over the 3 years. So when I say then how many will vest? Since 7 is leaving over the 3 years, that means at the vesting date, we are estimating in year one that only 13 will vest, which is 20 minus 17. That's perfectly correct. Let's say the question structured it like they say that 3 employees left, and the entity estimates that 4, or let's say 5 employees will leave in year 2 and year 3. So based on year one estimates, how many employees will vest? Husseini, I'm calling you again.
Sir. Sir.
How many employees will vest based on year one estimates?
15.
Okay, 15. How did you get that 15? Saying, how did you get that 15? You are muted, though. We can't hear you. So who else wants to try? How many
Sorry,
employees?
call comment.
What do you say?
Hello?
Yeah, I'm with you. You can go ahead.
Hello?
I'm with you. You can go ahead.
Hello, sir.
Okay, Oseni, so let another person talk. So how many employees will vest in year one?
Still 13. 13 employees.
13 employees. How did you get that one?
Okay, sorry. So you mean in year one, how many will vest?
Yes, any other person in class last week? Christiana, you were in class last week. Esang, you were in class last week. Most of you were in class last week. So why you're quiet? If you don't know this one, I can't move forward with this. It will just be a waste of our time.
The 15 will vest.
Okay, yes. Okay, you said I thought you wanted to change your mind, but we didn't hear you again.
No, sir.
Okay, so 13. Husseini said 15. Any other person?
12.
12 reversed. Okay.
I said 15. 15 will vest.
Oh,
No.
okay. I thought you said 13.
No.
Okay. Somebody, you said 15. You and Husseini said 15. Somebody said 12 reversed. I need one more person. So any other person? Okay. So Bidemi said 15. Okay. So it's serious. You guys don't still know this thing. Is it that I'm not teaching it very well, or you're not revising? It's frustrating. If you don't know this once, I mean, you don't know. So it's 12 that will vest in year one. So since they said in year one, 3 employees left in year one, and the entity estimates that 5 employees will leave in year one, in year two, and year three. So that means over the 3 years, 8 is the total number that will leave. 8 is the estimate that will leave. So based on year one estimates, only 12 will vest. The principle is simple. I don't know why you can't get this simple communication. How many will vest? Estimate of number of people that will vest. Is it the vesting that is the problem? Estimate of the number of people that will not leave. Abi, at the vesting date, at the end of the third year. So this is just like a primary one. We are just playing with words. That's what we are doing. In the first one, I told you that 3 left, and the entity estimate that 7 will leave over the 3 years. So 7 will leave over the 3 years. That was the first one that I told you. You got that one wrong. When they say 7 will live over the 3 years, that means we are estimating that 7 will live over, it's clear, over the 3 years. That means that the 3 they said left in year 1 is already included in the 7. So, I mean, it's like saying based on the 3 that have left in year 1, we are now estimating that, okay, it's 7 that will live in total. Now, I structured it in another way that, okay, 3 employees left in year 1. The entity now estimates that 5 will leave in year 2 and year 3. So that means the total, because it's estimating total. The only reason why this in year 1, I mean, we already know people that left in year 1, but it's not a year 1 thing. It's about estimate of people that will not leave at vesting date. That's the mindset we need to have. That, okay, how many people will not leave? Not in year 1, no, right? Though we are making estimates in year 1, but the estimates we are making, the only reason why we are making estimates is because it's about the future. That, okay, how many people will not leave at the vesting date, right? At the vesting date. So it's on that basis that we are going to then determine year 1 figures. So now when you say 3 employees leave or left, and the entity estimate that 5 employees will leave in year 2 and year 3. So estimate of total departure over the 3 years is 8. That means only 12 would remain. Okay, Bidemi, you want to ask a question? Please go ahead.
Okay, thank you, sir.
I'm with you. Bidemi.
This is the difference between the just asked. I think we are not getting the difference. That's why it seems we are not getting. Everyone is confused about it.
The line is breaking up. Hello,
Okay.
Bidemi. I didn't hear you. You haven't really communicated. So let's try another scenario. So they said, again, let's say 3 employees left, and the entity estimates that 2 employees will leave in year 2, and 4 employees will leave in year 3. Okay, let's say they put it this way. So in year 1 now, how many employees will vest? So let's try this.
$11.
11. Okay. Any other 12? Any other person?
Yes, 11.
Okay, I want Abidemi to talk because she was saying something which I didn't get. I mean, I think she was generalizing for everybody, like something but I really need every one of you to get this. It's very important because all my physical students now, they have actually gotten this very well. So 11 is the answer. 11 is the answer. So, okay. Let me give you one more. Still in year 1, let's say 3 employees left, and the entity estimates that 9 employees, no, 12 employees will leave over the 3 years. So, how many employees will vest? Based on year 1 estimates.
8. 8 employees.
8 employees. Okay. Any other trial? Any other trial? Please, I need 3 people to speak because I'm not just me. Somebody said eight
It's
employees.
8. 8.
8 employees. Okay, 8 is the answer. Okay. Now, let's say in year 2, let's say we're told that, please listen up. Oh. Let's say we're told that is a continuation of year 1. Let's say they told us that in year 2, 2 employees left in year 2. 2 employees left in year 2, and the entity estimates that 6 will leave in year 3. So what's the estimate that will vest in year 2? Two employees left in year 2, and the entity estimates that 6 will leave in year 3.
9 employees will vest.
Okay, 9 employees will vest. Okay. Any other person? Any other person? You're waiting. I mean, the earlier we respond, the faster we'll finish this class. Otherwise, this is where we will act till 10 o'clock. Then we'll close. Then we'll be behind. Any other person? So you said 9. Yes, 9 is the correct answer because they said in year 2, 2 people left, and now they're estimating that 6 will leave in year 3. That means over the 3 years now, we know that 3 has left in year 1. That one, we know that one for sure. Now they are saying 2 is now leaving in year 2, making 5. So in year 3 now, we have to estimate. So they are now estimating that 6 will leave in year 3, making a total of 11. So that means the number that will vest is 9. So you're perfectly correct. Oh, okay. Yeah. So Bidemi, I get you now. We have now moved to year 2. So let's look at another scenario. Let's say they said 9 will leave. 9 will leave over the 3 years. Okay. So they said 2 employees left, and the entity estimates that 9 will leave over the 3 years. So how many will vest based on year 2 estimates? Yes. Bidem, I will explain. I'm coming. Let me finish this year 2, then I'll explain again. Okay, who can tell us how many will vest based on year 2 estimates? Okay, somebody mentioned 11. Any other person?
11.
11. Okay. Any other person? So I want to assume that every one of you you're getting it. I just hope so. So 11 is the correct answer, right? So at least now I'm sure that two of you understand it because those are the two that are participating, right? So I'm not sure of the other people. So Bidemi, I mean, everybody has gotten it. I mean, now we are represented by Tintin. I mean, that's her name on her this thing, and also again, those two they have gotten everything right. So I want to assume every other person too got it since they have decided to keep quiet and not talk. They cannot even type the answer there. So now in year one now, we said 3 employees left, and the entity estimates that 12 employees will leave over the 3 years. So we are now asked, what we need to answer is that how many employee will vest, right? And when we say vest, vesting is happening after 3 years, okay? What that simply means is that how many employees will not leave. And there's no way we can know with certainty the number of employees that will not leave in year 3. We can only estimate, which is why the standard said, okay, estimate the number that will vest. So, and when we say vest, we are talking about year 3. And this question has given us everything you need. They told us that, okay, at the end of year 1, 3 people left. We now estimated that, okay, based on that information, okay, 12 will leave over the 3 years. Okay, so that means only 8 will not leave. Only 8 will not leave. That's the estimate in year 1. And that's the answer for this one. Only 8 will not leave, since 12 will leave over the 3 years. So that means this 3 is even already included in this estimate because they said over the 3 years. Another one I did was if they had told us that 8 employees will leave in year 1 and year 2. So in that case now, Bidemi, can you try this one? I hope Bidemi is still here. You can
Yes,
type the answer.
I mean,
Yes. Okay. You can just type the answer or talk. Either one is okay. So how many will vest based on year 1 estimate? Sorry, can be in year 2 and year 3. That's what it should be. Because we need an estimate for the 3 years. So what do you think?
will it be 12?
So no, it's not 12. So yes, I think this was where you were before you left the class. So now they told us that 3 employees will leave in year 1. They now estimated that 8 will leave in year 2 and year 3. Okay, that means in total, 3 plus 8 are going to leave over the 3 years, 11. So that means the number that will vest is 9. The number that will vest is 9. So, I mean, you just need to understand how many will not go. That's the idea. How many will not go? However, they juggle the words together is very straightforward. So, in year 1, they said 3 will leave. Then I estimate that 8 will leave in year 2 and year 3. I mean, the whole idea is how many will not go in year 3. And it's an estimate. So 3 is leaving in year 1. We now estimated that additional 8 will leave in year 2 and year 3. That means a total of 11 will go. So it's only 9 that will not go. It's only 9 that will enjoy that option. And that's that 9 that we need to work with in year 1. Turn again. Okay, Abidemi, did you get that?
Yes, yes.
Okay.
Thank you.
So we then went to year 2.
Sorry, sir. Do we have a threshold? Like now, the last one you just said, you said 11 will leave in total. Out of how many?
20. We have 20
Oh,
employees.
okay.
Yes.
Okay. I get it.
Yeah. So now let's go to year two. I want to believe everybody understand that. So year two is the same thing. So in now saying year two, two people left, and the entity estimates that 9 will live over the 3 years. Over the 3 years. Abdemi, can you try this? So in year two, now how many will vest? And when I say how many will vest, I mean, what's the estimate of people that will not leave? That's what we mean. Estimate of people that will not leave at the end of year three, based on year two estimate. So, and the year two estimate is that, okay, additional 2 people left. Then we now estimated that 9 will live over the 3 years. So, how many will vest?
So altogether, 11 left. So we'll have 9 that would stay, that will not
Okay.
go.
Okay. Okay. So, is she correct? Can anybody tell us the right answer?
Yes, he's
She's
correct.
No,
correct.
she no no,
She,
she's not
she.
correct, sir.
So, what's the correct answer?
The correct answer is 11 that will stay when 9 will go because the 9 is over the 3 years.
Thank you very
So
much. Thank you very much for saying it. Okay, so I mean, the 9 is, as I have said it, the 9 is over the 3 years. So that means the examiner has already factored in these 2 that have left in year 2, these 3 that have left in year 1. They have factored it inside this 9. I mean, it's there. They then estimated 9 over the 3 years. So you should watch out for this period. The estimate that they give you, you should note it for what period. If it's for the entire period, that is the total, that's the estimate. Because what the standard said is make an estimate for the people that would leave or the people that would not leave, something like that. So when they say 9 will leave over the 3 years, that means the total departure is 9. That means only 11 will not leave. Okay, so good one, Husseini. So let's say they told us that 4 or 5 in will live in year 3. So Isang and Abidemi, let's see, can you try your hands on this one? How many will vest in year 2?
That's 13. Abi?
Okay, you're going for 13 will vest in year 2. Okay, I can see why you're going for 13, but you're missing out 1 year. It's not 13. It's actually 10
But
that we
this is for year 2 now. Okay,
Yes,
let's analyze it. 2 employee left.
in year 2.
That in year 2.
Mm-hmm.
And the entity estimate 5, that 5 will leave in
In
year
year,
3.
yes. So what's the
Uh-huh.
estimate total departure? So how many people left over the 3 years?
Is 7.
No,
it's
that's
10, sir.
it's 10 that left over that 7 you are looking at. You are looking at only for 2 years. You are not considering the 3 that actually left in year 1 too.
In year 1.
Uh,
Okay.
yes.
Okay.
You need to look at it over the 3 years. So don't just look at year 2 in isolation, except if in year 2 they estimate people that will live over the 3 years, just like the previous one that I claimed, then fine, you're good to go. But if they give you like a piecemeal estimate like this, then you need to put them together, actual plus estimate, so that you can have a total estimate. So for this one now, the total estimate of departure is now 3 left in year 1 2 left in year 2, 5 left in year estimate of 5 will leave in year 3, making a total of 10 that will leave. So on the basis of year 2 estimate, 10 will not leave. 10 will not leave. Okay. So let's say that the entity estimates that 7 will leave in year 2 and year 3. Let me not use 7. Let me use 9. So based on year 2 estimate, how many will vest?
Two, nine. Should we include year 1
Yes,
in it?
you have to.
Okay.
We need over the
A
3 years.
total of 14. A total of 14 will leave.
Over the 3 years. So
Yes.
you are saying 6 will not leave, Abi?
Yes. 6 will vest.
That's wrong.
So it is 12 that will leave, well, 8 will vest.
That's correct. That's correct. Look at it, Isang. Look at the estimate they give us in year 2. They said 2 employees left in year 2, and the entity now
Yes.
estimates that 9 will leave in year 2 and year 3. So these 2 now, is already included here. So for you to now be counting 2 again, you are double counting, because they have now estimated now for year 2 and year 3. So they have put the 2 together. So this 2 is already included based on this, the way they have structured this. So that means for year 2 and year 3, we're estimating that 9 will leave. Okay, on the basis of the fact that 2 actually left. So they estimate that 9 for year 2 and year 3. And considering that 3 left in year 1, that means a total of, we are estimating that 12 will leave over the 3 years, which goes to show that 8 will not leave, 8 will vest. Is that clear?
Yes. Yes.
Okay. Abidemi, you're not saying anything again. Hope you are following.
Yes, I'm just trying to draw like a logic from it. That's why I was trying to observe.
Okay, observe. This one, you're sounding as if you're already sleeping. Don't sleep. Oh.
No, I'm not sleeping, sir.
Okay. In year 3, let's say we're told that none left. Let's say they told us in year 3, none left. So what's the estimate that will vest? In fact, year 3, there's no need for estimates, because in year 3, we will know that's the vesting date. So how many actually vest in year 3?
It's the same 8.
Okay, 8 vest in year 3. Okay. Any other idea?
15.
15 is the answer. Because in year 3 now, we need to know the actual number of people that actually vest. And knowing fully well that 3 actually left in year 3, 2 actually left in year 2, and none left in year 3. So in year 3 now, we don't need to work with estimates anymore, because that's the vesting date. We will have known the number of people that actually left. So now we know for sure that 5 actually left. So 15 will vest. Okay. So I think I've been able to help you guys.
Yes, sir. It's honest.
Yes. So, and that's really, if you understand that, there's really nothing much in share-based payments. It's just that. It's not beyond that. You just need to understand those. So let's solve questions now. So let's solve like 3 questions on this together. So let's look at this question. We started with this question last week. Let's quickly finish it. So on 4th January 2001, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 2003. Okay, so based on this sentence now, that means 1st January 2001 is the grant date. Grant date. That's the date we gave the options. So we give 100 share options to each of its 400 employees. So each grant is conditional upon the employee working until 31st December 2003. So that means the vesting period is 3 years and 31st December 2003 is the vesting date. So we're now told that the fair value of each option is 20 naira. So this 20 naira is how we're going to measure that option, because equity settled share-based payment is measured at the fair value of the option at the grant date, so which we have been given. It now said during 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. During 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. So in 2001, how many will vest? I'm asking you. In 2001, how many will vest? Anybody?
$320.
Okay, that's correct. That's correct. 320. So, and that 320 is in the fact that we have 400 employees, and the question told us that, okay, 20 employees leave in year one. We are now estimating that 20% of our employees will leave over the 3 years. So this is the estimate of people that will leave over the 3 years. So if 20% is leaving, that means 80% will not leave. And if you punch your calculator, if you do 80% of 400, that simply will give you 320. So she's perfectly correct. They said during 2002, a further 25 employees leave, and the entity now estimates that 25% of its employee will leave during the 3-year period. So how many employees will vest? I'm asking you. So how many employees will vest in 2002? Anybody?
Is it 300?
That's correct.
300.
Yeah, correct. 300. So 300 is the answer. Since the question already told us that, yes, in 2002, a further 25 employees leave, and the entity now estimates that 25% of its employee will leave during the 3-year period. I mean, the question is giving us estimates of total departure for the 3 years, which is what we need. So since 25% is leaving, that means 75% will not leave. And if you punch your calculator, 75% of 400, that means 300 will not leave. Then I said during 2003, a further 10 employees leave. Okay. And 2003 is the vesting date. So this one is not estimate. How many is now vesting in year 3?
It's
How many?
45.
345.
That's
340. Three for five.
That's correct. 345. 345 is the answer. Because 20 actually left in year one, 25 left in year two, 10 left in year three. So a total of 55 left over the 3 years. So 345 actually vests. Okay, fantastic. So you all got it. So that's the only thing that is changing there. Every other one is just there, static. And if you look at the solution, I did some explanation for you here, what you know. So if you look at 2001 now, we are giving them 100 options. We have 400 employees and 80% will not leave. So that gives me 320. Then you then measure it at the fair value of the option at the grant date, which is that 20 naira, this 20 naira. The fair value of the option at the grant date. So if you punch your calculator, whatever you get is like the value of the option based on year one estimates. So we cannot recognize the whole of that amount in year one. Okay, it's not like it's vesting in year one. Year one is just, okay, we are estimating that, okay, this is the value. So that amount, we need to spread it over the 3 years. So the one that relates to year one, we simply say 1/3. And that will give us 213,333. 213,333. So it's like we are debiting expense, P&L, usually staff costs. This expense for the year is staff costs. They will put it as part of staff costs. This cumulative expense is like equity. This one goes to equity reserve. Let me put it under here. It goes to equity reserve under equity because this is equity settled. So the corresponding credit will go to equity. So it's like you are debiting this one and you're crediting this one. So I hope you all understood this 1/3. So this 1/3 is happening that we cannot recognize everything in year one. This thing is happening in year three, but the employee is working for 3 years. So accrual basis requires that you systematically spread the costs. Okay. So the ones that relate to year one, you do 1/3. Now, you see, this one that goes to expense, you would take it to P&L. You take it to P&L. But you see, this one that is going to reserve, it will be in the statement of financial position as reserve. And you know that what goes to statement of financial position will be carried forward to next year. You will carry it forward. Items like assets are carried forward, liabilities are carried forward, equity are carried forward. So this one, equity will be carried forward to next year. So it becomes an opening balance next year. So this 21333 gets carried forward to next year. Why this one that goes to expense is expense for the year to P&L. It ends there. So now in 2002, we are giving each of those employees 100 options, and we are estimating that 75% of our employee will not go, will not leave, will vest. So which is 300, like you have rightly told me. Then you measure it at the fair value of the option at the grant date. This one does not change. So in year two, you do cumulative, right? So you want your reserve to carry the cumulative so that when you look at the reserve, you are seeing what the employees have accumulated for themselves for the 2 years. And that's why we are doing 2/3. Okay, when you punch your calculator with this, it gives you 400,000. That's the cumulative for the 2 years. And that's the balance in your reserve. It's cumulative for year one and year two. So what goes to expense is the difference between the cumulative, the reserve in year two, and the reserve in year one. So the increase in the reserve will take it to expense for the year. So, and that's 186,667. That's the increase in the reserve. I hope that is clear. Now, in year 3, we are giving each of our employees 100 options, and we're told that we have 400 employees. We're told that 20 actually left in year 1, 25 actually left in year 2, and 10 actually left in year 3. So whatever balance you have, we then multiply that by the fair value of the option at the grant date. So since this is year 3, the vesting date, so it's like saying multiply by 3/3, which is 1. So that's why you didn't see me put anything there. That gives us a cumulative figure of 690. I mean, this 690 means that this is the value of the option that we are giving to our employees as at this date. This is the value. So what goes to P&L is the increase between year 2 and year 3. So it's like saying the reserve has increased from 400 to 690. It has increased by 290. That goes to POL. And that's that. So you will see that the only technicality here is just this is the variable that is changing, the number of employees that will vest. And that's how you solve it in the exam. Because the examiner will ask you to calculate the remuneration expense that will be recognized in respect of the share-based payment. And these are the expense. And you see the way I calculated expense in year 2 and year 3, I was looking at the increase in the reserve between the intervening periods. Let's solve another question if you don't have any question for me. Now, year 2, our question 2, this one says that on 1st January 2003, an entity grants 250 share options to each of its 200 employees. The only condition attached to the grant is that the employees should continue to work for the entity until 31st December 2006. 5 employees leave during the year. The market price of each options was 12 naira at 4 January 2003 and 15 naira at 31st December 2003. Required. Show how this transaction will be reflected in the financial statements for the year ended 31st December 2003. Okay, so speaking of 2003, which is the grant date, 1st January, so we are giving 250 options to 200 employees, and they say that they must work until 31st December 2006. That means they must work for 4 years. That's 3, 4, 5, 6. They must work for 4 years. So 5 employees leave during the year. That means in year 1, 5 employees leave in year 1. So let me ask, how many will vest in 2003? What was the estimate of employees that will vest?
195.
Okay, 195. Any other suggestion?
It's still 195.
Okay, 195. And Praise says he will make his estimate. Okay, so Praise, I didn't quite get you, but if you say 195 and you are just looking, you're wrong. You're wrong because 5 left in year 1. What about if other people live in year 2 and year 3 or and year 4 because there are 4 years here. So this guy
But sir, the question say 5 leave during the year.
yes. So the question believes you understand the principle. That the principle is that we need to make estimate of people that will not live over the 4 years. So even if the question is silent, that means they want you to make estimates of people that will live in year 2, year 3, and year 4. So if you just say 195 and you're looking, the examiner will mark you bad. because you will say you are wrong, that you are basing your working on year one alone. And when they say what we need is the number of employees that will vest. So except if you now put in your solution that you're estimating that no employees, no further will leave in year 2, year 3, and year 4. So if you estimate that no additional employees will leave, then fine, you are correct. 195 is correct. But if you just say 195 and you did not, the examiner believes you don't understand the principle yet, and it will not give you your mark. You see, the aim of this question is just for me to re-emphasize the understanding of this number of employees that will vest. That what we mean is the number of employees that will vest at the vesting dates. So in year one, when I say number of employees that will vest, I mean number of employees that will vest at the vesting date. Number estimate of employees that will not leave. So when they tell me that 5 employees leave in year one, I need to ask, I need to make an estimate of people that will leave in year 2, year 3, and year 4. I can say 0, but I have to make that estimate so that whoever is reading my report will understand that, okay, I'm following the standard. I'm making an estimate of the people that will not leave over the 4 years. Over the 4 years. So that's where you are not right. And me, I will have just played safe. Since they told me that 5 leave in year one, I will just say, and the examiner did not give me estimate. I will just estimate that, okay, 5 will leave in year 2, 5 will leave in year 3, 5 will leave in year 4. I would put it there in the question, in my solution. That, okay, since 5 left in year 1, I'm estimating that 5 will leave in year 2, year 3, year 4. 5, 5, 5, 5. And that means a total of 20 will leave over the 4 years. So the number of employees that will vest will be 180. That is 200 minus 20. 180. And that's the major thing there. So 250 multiplied by 180. And you can make another estimate. It's open. Okay, it's open. But in the exam, the examiner will not give you an open question like this, that you should be making estimates. They will always make that estimate for you. So the exam is even mostly straightforward. It's just for you to understand that what we mean is the people that will not leave at the vesting dates. Is estimate of people that will not leave at the vesting date. So this question is just for me to remind you again that it's not about just that year alone. It's about over the period. That's the consideration. That's the point of note. Okay. So how do we measure this option? They give us the market price of the option at the grant dates, and they also give us the market price of the option at the year end. So which one are we using? Grant date or year end?
Grant date.
Thank you. We are using grant date, which is 12. Okay, so we just need 25 times 180. That will give us 45,000 multiplied by 12. So whatever figure you get, you spread that over 4 years. So we divide it by, we multiply it by 1 over 4. And that gives us 135,000. Okay, so this 135,000, one leg will go to P&L as staff costs. The other leg will go to equity reserve in year 1. And that's that for that question. Any questions? Okay, let's go to another question. This one says that J and B granted 200 options on its 1 era ordinary shares to each of its 800 employees on 1st January 2001. each grant is conditional upon the employees being employed until 31st December 2003. So that means 1st January 2001 is the grant date. There are 800 employees. We are giving them 200 options. So this ₦1 is the nominal value of those shares. So I said that we have to employ them till 31st December 2003, which is the vesting date. And that's how many years? 1, 2, 3. So that's 3 vesting period. We're now told that J and B estimated that he estimated at 1st January 2001, which is grant date, that the fair value of the option was ₦1. Approximately 50 employees will leave between 2001, 43 in 2002, 33 in 2003. So they will forfeit their right to receive the options. The departure were expected to be evenly spread. Okay. We're not told that the exercise price of the options was ₦1.50, and the market value of a J&B share on 4th January 2001 was ₦3. So they gave us the exercise price, and they gave us the market value of J&B shares. In that sense, in the event, only 40 employees left in 2001, and the entity estimated total departure was revised down to 95 at 2001, 20 during 2002, and the entity estimate of total departures was revised to 70 at 2002, and none during 2003, spread evenly during the year. Okay, so what were the estimates given? So they made an estimate at the beginning of the year. Ordinarily, I will have just ignored the whole of these estimates because the standard says that estimate of the number of employees that will vest should be made at the year end, at each year, not at the beginning of the year. But I will really need the fair value of the option because that is what I will use to measure my option. So this is the only thing I would need here. You see all these other ones, it's just a distraction. You don't need them because those estimates are made at the end of the year, not at the beginning of the year, except if the question tells you that, okay, at the end of the year, this is what that we are supporting our estimate at the beginning, right? That's the only instance where we might come back to this. But as far as these two points are concerned, it's only point 1, which is the fair value of each option, that is relevant here. So having mentioned that, they gave us the exercise price and they gave us the market value of the shares. So some students will be confused between this ₦3 and this ₦4. And that this market value of shares, this fair value of option, that what's the difference between the two? Which one are we supposed to use? Because this one too was given on the grant date, while this one too was given at the grant date. So which one are we using? Of course, we are using this ₦4 because what we are giving to our employees are share options, not shares. So this one gives us the fair value of the option, ₦4. But you see this ₦3 is the market value of the shares itself. Okay, the shares, they are different. Okay, and we don't need the market value of the shares at the grant date. What we need is the market value of the option because that's what we want to measure. That is what we are giving to our employees. Okay. Okay. Now said in the event, okay, that is at the year end, in the event, they said only 40 employees left during 2001. And the entity estimate of total departure was revised down to 95 at 31st December 2001. So, how many employees would vest based on 2001 estimates? So, how many employees will vest? Anyone?
So in year one,
705.
Yes, in year one. Yes, that's correct.
705, yes.
705 will vest in year one. That's correct. What about in year two? What's the estimate of vesting in year two? How many employees will vest?
730.
Okay, that's correct. 730. How about in year three? They said none during year three. So how many actually vested in year three?
740.
That's correct. 740. Okay. I mean, that's the only thing that's changing. Every other one the same. So if you look at it, in year one, we are giving each of them 200 options. So 800 minus 95. 95 was the estimate of total departure. And this 4 naira is the fair value of the option at the grant date. So we got 564,000, which we are going to spread over the 3 years. So 188,000, one leg will go to staff cost in P&L, the other leg will go to equity reserve in the statement of financial position. In year two, 200 multiplied by 730, which is 800 minus the estimate of total departure, multiplied by the fair value of the option at the grant date. So 584,000 multiplied by 2 over 3, that gives us 389,333. So this 39333 is the reserve, is the balance of the reserve. It's the balance of the reserve in year two. That's why you did multiply by 2 over 3. So what goes to staff cost is the increase in the reserve. The balance of the reserve in year two is this, minus what we have in year one. So increase in the reserve is what goes to staff cost, which is 201,333. 201,333. In year three, 200 options multiplied by 800 minus 40 minus 20, because 40 left in year one, 20 left in year two, and none left in year three. So multiply that by the fair value of the option at the grant date. Then we have 592,000. And that's the value of our reserve. That's the worth of this option that we need to give to our employees. What goes to our staff costs is the increase in the reserve. Is the increase in the reserve, which is 592, the balance of the reserve in year three, minus 389, the balance of the reserve in year two. So the difference or the increase goes to staff cost and P&L. That's that. I did some accounting entries here. So with the increase, the way I'm debiting P&L and crediting reserve in each year, with the increase in the reserves, with the increase in the reserves, like that, debiting P&L, crediting equity reserve. Now, the additional thing here is that you see this balance of 592 at the vesting dates is the value of the option that will then be converted into shares to our employees, right? That's value 592. But you see, this option value, the employees will actually pay for it. It's not free. They will pay for it. And the money they are paying for it, we call that exercise price. That's the exercise price of the option. Exercise price. So that's 1 naira 50 kobo. They pay. They will pay. Just that the money they will pay will be small compared to the market price of those shares. Now, you see, the money they are paying, this 1 naira 50 kobo, we are giving each of them, we are giving each of them, there are 740 employees. Remember the way we got the 740? The 800 minus 40 minus 20. That's 740. We are giving each of them 200 options, and we will collect 150 kobo from them. You see that I'm debiting cash. Okay, that gives us 222,000. So I'm debiting cash. That gives us 222,000. And also, my equity reserve, I will need to debit it to cancel it off, because now I want to give shares to my employees. That reserve is no longer needed. So our reserve has credit balance, so I need to debit it to cancel it off. So I debit my equity reserve. Now, having debited my equity reserve, the corresponding credit should then go to share capital, because I will then issue shares to those employees. But what goes to your share capital account is restricted to the nominal value of those shares. Is restricted to the nominal value of the shares. So we have 740 employees. We are giving each of them 200 options multiplied by 1 naira, which is the nominal value. They gave us the nominal value at the beginning of the correction. This 1 naira here. So whatever you take to share capital is always at nominal value. So what you can credit to share capital is restricted to the nominal value. Multiply this 3, it gives us 148,000. So, but you still need where you put, because these old debits, 222 and 592, we're supposed to go to share capital, but only 148 can go to share capital. So any excess amount above what we want to credit to share capital usually will go to our share premium. So that's why I wrote balancing figure here. So if you do 222 plus 592 minus 148, you will get a balancing figure of 666,000. You get a balancing figure of 666,000. And that's what we're going to take. And that's how we issue shares. That's how we convert those options to share capital. And that's that question for you. Any questions? Is that clear, everyone? Yeah. Okay. I think I can only go one more question. This last question, so I want to struggle because I think I'm tired already. Let me solve one more question today. I'll round up this class for today. So let's solve a question on cash settled. You see, the entire principle, the measurement basis is the same for everything entirely. So the principle for equity settled is exactly the same thing for cash settled. Is the same. Is the same principle around, okay, estimate of the number of employees that will vest. That's how we determine how much for each year. Is the same. The only difference is that number one, for cash settled, the entity, the employer, um, he has promised to give cash to the employees, and he now base the value of those cash on its share price. That's just the difference. He has promised to give cash, but the value of those cash is based on its share price, right? So in that case, the employer has an obligation to give cash. And whenever we have an obligation to deliver cash or give cash, that's a liability. Unlike equity settled, where we're crediting equity reserve, for cash settled, we usually credit liability. That's one difference. Secondly, for equity settled, where it was measured at the fair value of the option at the grant date for each year, but for cash settled, it's usually measured at the fair value of those options at each year end, at each reporting date. So they measure it at each reporting date. And thirdly, for equity settled, we usually give the employees share options or shares. The one we have been working with is share options. But for cash settled, what we give the employees is share appreciation rights, which is a right that that is saying that we are going to give the employees cash based on appreciation, based on the increase in our share price. We know that our share price can go up or down, but we are attaching the money we will give them based on only on the increase. That if our share price will increase by this percentage, we'll pay you based on that share appreciation right. Or they give those employees redeemable shares, which are shares in which the entity can buy back, in which the entity can collect it back from them and give them money. That's redeemable shares. So settled, what they give to the employees would ultimately result in the entity giving the employees cash. And those are the difference between cash settled and equity settled. So let's solve this question to attend to that. It says on 1st January 2001, an entity grants 100 cash share appreciation rights to each of its 500 employees on condition that the employees continue to work for the entity until 31st December 2003. Okay, so that means this is the grant dates. Okay, 100 share acquisition rights, 500 employees. And you are saying that they need to work for us till 31st December 2003. That's 3 years vesting dates. 1, 2, 3. That's 3 years vesting date. When I told that during 2001, 35 employees leave, and the entity estimates that a further 60 will leave during 2002 and 2003. I hope you guys are not sleeping already. So, I
No,
mean,
sir.
let me be prudent. Oh, okay, good. So, how many employees will vest? Based on
465.
how many?
440.
No, that's wrong.
60 live during the, okay, sorry. 430, 30
4,
probably.
5.
405. 405.
Yes, that's correct. 405. Because 35 will live in year one. We're now estimating that a
60,
further 60 will live in year two
60
and
over
three. So that means
3.
a total of 95 will live over the 3 years. So
Yes,
minus 500, that's 405. So let's go to
4.
year two. It said that 40 employees leave, and the entity estimates that a further 25 will leave during 2003. So how many will vest?
Copy.
400.
That's correct. 400, because they said 40 employees will leave in year two, and we estimate that a further 25 will leave in year three. So that means that in year one, 35 is leaving, in year two, 40 is leaving, and we're estimating that 25 will leave in year three. So a total of 100 is estimated to leave. So that means 400 will not leave. Correct. 2003, they now said 22 employees actually now leave. 22 employees leave in year three alone. So how many will not leave? How many actually vest?
That's 403.
That's correct. 403. That's correct. However, there are some complications here for cash settled. They told us that because they can start, they will vest in 2003. So actually, in that 2003, 150 of the employees exercised their share acquisition rights. And for share acquisition rights, we are saying we are going to give you cash if our shares should appreciate. So for this 150 to exercise, it means that we're going to give them cash, right? Then another 140 employees exercise their rights in 2004. I mean, that shows that all of them are not exercising at the same time. And this can only happen for cash settled because it's measured at each end. So most of them might delay it. Unlike equity settled, that is measured at the grant date, and immediately the vesting date is here, they want to get their shares and exercise and pay whatever it is they need to pay so that they can get those shares. But for cash settled, they don't necessarily exercise all at the same time. So 140 exercise in 2004, and the remaining 113 exercise at the end of 2005.
Right.
So we need to address all of this. We're not told that the fair value of the share acquisition right for each year in which the liability exists as shown below, together with the intrinsic value at the date of the exercise. So they give us the fair value of those rights. And you see, this fair value at each year end of those rights, this is how we measure cash settled. They are measured based on the fair value of the right at each year end. And I told you that that is a point of difference between cash settled and equity settled. For equity settled, it is measured at the fair value of the options at the grant date. But this is measured at the fair value of the right at each year end. They also give us intrinsic value. This intrinsic value can be used in place of exercise price, which is the amount we are going to pay the employees. This is their profits. This is what we are going to pay them. So if they had given us exercise price, we will have used exercise price. But they didn't give us that. They gave us intrinsic value. So we are good to go. The question now says that calculate the amount to be recognized in profits for the 5 years. not just for the 3 years between when we grant them and when they are vesting, but for the 5 years, that is up to 2005, and also get the liability to be recognized at the same time. Okay, so I mean, two things are changing here. The number of employees that will vest in each year, which you have told me, and also we need to be using the fair value at each year. So for year one now, it's just as you have told me. We are giving each of them 100 share appreciation rights. Only 405 is the estimate that will vest. Only 405 is the estimate that will vest. Then multiply that by the fair value at the end of that year. Then we prorate times 1/3. That gives us 194,400. So we're going to debit staff cost with that, and we're going to credit liability. I hope that one is clear. So all of those figures are given to us. In year two, the value we are giving 100 share acquisition right to each of our staff. And based on the question, 500 employees, 35 left in year one, 40 left in year two. We now estimated that 25 will leave in year three. So the balance is the people that will vest. Multiply by the fair value of the right at the end of year two. Look at it. I hope you haven't forgotten this one. At the end of year two. So when you calculate that, it gives us 413,333. And that's what will go to the value of our liability. That's what will come in as our liability. And what goes to P&L is the increase in the liability. So in year one, the liability was 194,400. And in year two, the liability is 413,333. So the increase in the liability is 218,933. And that's what goes to our staff costs. The increase in the liability. Now, in 2003, how do we then get the value of our liability in 2003? Because in addition to the people that left in year three, some people also exercised their rights. So those ones too are good as people that left too. This 150. So 22 employees leave. Then additional 150 exercised their rights. So this 150 that exercised their rights, we need to pay them. So we need to calculate how much we are paying them first so that we'll know what is remaining. And that is why the first thing I did in 2003 was to determine the value of what we are paying those that exercised. So we are giving each of them 100 share acquisition rights. 150 of them exercised, and we are paying them 15 naira per rights. And this 15 naira is the intrinsic value. And this is where I got the intrinsic value from the question. They gave us the intrinsic value already. So when I do the math, I get 225,000 as the worth of the money I would pay to those that have exercised. Since I'm settling them, I will debit my liability. I will credit my bank. Since I'm paying them, I'm settling off my liability. Therefore, the balance of my liability is now my 413,333, which is the value of my liability is at the end of year two, which is this one. That's the value of my liability, the one I got in year two. It will be carried forward to year three. So out of this 413, I've settled this amount. I've settled this. So my liability is now remaining 188,333. Now, having taken care of those that have vested or those that have exercised their rights, let's now know, okay, how much are we now owing? What is remaining? Knowing fully well that each of those people that are remaining will get 100 share appreciation rights. And from the question, I have 500 employees, 35 left in year 1, 40 left in year 2, 22 left in year 3, and 150 has exercised. You see, this is where I'm getting it from the question. We did this together. 35, 40, 22, and 150 that exercised. So whatever figure you get here, would have done it here, which is 253. You then multiply by the fair value of that right at the end of 2003, the fair value of the rights, not intrinsic value here. We want to get the value of those that did not exercise so that we can know how much are we owing those ones. So this 18.2 is the fair value of the rights at the end of 2003. So when I multiply that together, these three, I get 460, 460. Then that becomes how much I'm owing those that have not exercised. This 460, 460 will come in as my liability. The figure that goes to my P&L is the increase in the liability. Knowing fully well that my balance of my liability from this workings here is 188,333. So it has increased to 460, 460. That increase will go to P&L, and that gives me 272,127. 272,127. Now, in 2004, we're told that in the question, where is it? Another 140 employees exercised their rights. 2004. So in 2004, let me get those people that I need to pay also first. So 140 employees multiply by 100 share acquisition, right? Multiply by 20 naira. This 20 naira is the intrinsic value at the end of 2004, which I got from the question here. 2004, 20. Now this 20, when I multiply these three together, I get 280. This 280, I will need to pay them. I will need to settle them off. So I debit my liability, I credit my bank. So the balance of my liability is the opening liability, which is 460, 460, the balance from year 3. Then I will need to pay this out of that. So minus 280,000. And that gives me 180, 460. Having settled those 140 people, then let's get the value of what I'm owing after I've settled those ones. Don't forget, the number of employees that was remaining at the end of the previous year was 253. Now, additional 140 have exercised. So I'll be left with 113. So 113 multiplied by 100, multiplied by the fair value of those rights at the end of 2004. That gives me 241,840, which I will take to my liability. What goes to my POL is the increase in the liability. Don't forget, the balance of my liability was 180,460. It has increased to 241,820. So there's an increase of 61,360. Then the question told us that The remaining 113 exercised their right at the end of 2005. So in 2005, the remaining 113 employees from here exercise their rights, and I will need to pay those remaining. So 113 times 100 share appreciation rights multiplied by the intrinsic value, it gives me 282,500. I will need to pay them this amount, so I debit my liability, I credit bank. However, what I'm paying them is more than the balance in my liability, because the opening balance in my liability is 241, but now I have to pay 282. So that means I'm incurring additional costs of the difference that will go to P&L. I'm paying 282. I was owing 241. So I'm paying additional 4680, which I will take to P&L. We're going to stop here for tonight. Next week, we'll proceed to the next part of our syllabus. Do we have any questions? Okay, thank you very much.
Thank you very much, sir. We
Thank you,
appreciate
sir.
it.
Okay, bye.
Thank you, sir.
Yeah.